Hey there, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. I learned the technical analysis toolkit a couple years ago as really a way of understanding the markets. Before learning the technical analysis toolkit, I tended to be surprised by what was happening. I tended to not really understand leadership and laggership, what was working and what was not. I really didn't have a good framework with which to understand all of the flickering ticks, all of the different competing narratives and news flows that I heard and saw around me. After learning the technical analysis toolkit, which I would argue is a lifelong pursuit that hopefully you enjoy as much as I do, you will find that your what I call situational awareness as an investor dramatically improves. A regular and disciplined use of technical analysis through chart routines, I think, can be essential for an investor or a trader to really understand the market environment. As we look at the markets here, getting toward the later parts of January of 2024, obviously strength is the number one observation, right? Growth stocks once again leading to the upside. Mega cap names dominating the return profiles, some of the largest names having some of the best returns so far. As a result, our benchmarks are at all-time highs today, continue to push to the upside for the S&P, the NASDAQ, and elsewhere. There are some things to get concerned about, and I would say there are some clear patterns to be observed and also levels to pay attention to that could be a great indication that this bullish run that we're experiencing currently is over. And I'll share with you some of those levels and some of those patterns that I'm looking for here. With that in mind, let's get to our market recap, see how things played out through the course of the trading day today. All right, before we get to the charts and the market recap, let's talk about a poll I shared over the weekend. We asked you, how would you describe your technical analysis expertise? And I love this question because it's really interesting to see where everyone is at. What I'm most concerned about is 8% of you said you were a legend and you could sit in my seat and host the show any day. I welcome the challenge. I mean, please, good luck. It is an incredibly rewarding experience and not easy at times to try to make sense of things and boil a busy market environment down to a small number of points. But if you're at that level, I wish you well, and I wish you very much success. A number of you mentioned you're just getting started, about 18% of you. And if you're in that first bucket, I would encourage you to check out Chart School. Chart School is a free portion of the Stock Charts website. The amount of content on here is really breathtaking if you want to understand the markets better. When I was learning technical analysis and studying for the CMT exams, I liberally used the Chart School portion of the website to just learn more about particular indicators, look for some great examples to use, and just really get more and more practice, more reps under the fingers to get ready. Number of you said you're intermediate, and I would encourage you there to focus on the articles page, because if you hear from some of our expert commentators, many of these are power users of the Stock Charts platform. And I would say if you kind of know technical analysis, but you're really looking to upgrade, look at some of the tools and techniques that our commentators use. Look at the charts that they're using. Try to recreate them on the Stock Charts platform and see how it can help improve your understanding of the overall environment. If you're in that advanced bucket, I would very much point you to our scanning engine, our alerts functionality, our chart list tools, just the ability of looking at a series of stocks and ETFs as an RRG, looking at relative rotation, scanning for new stocks and ETFs that fit your criteria, just always looking for new ideas, alerts to make sure that you manage risk effectively. I would say wherever you're at on that spectrum of awareness of technical analysis, there's always something new to learn. Hopefully, Stock Charts can be a part of that learning process for you going forward. Let's get to the market recap in earnest, and let's look at the S&P 500 up 48.50 is basically the close here today. That's up about 0.25% from Friday's close. Friday, of course, the big move higher, new all-time highs for the S&P, a level that and an event that seemed at one point last year like it was never going to happen, or in the end of 2022, when you're seeing the market accelerate into an October 22 low. S&P 48.50 seemed like a joke, right? Something it would be a punchline to some joke about ridiculous optimism, but we're there, right? We're making new highs, and today even pushing a little bit higher after that rally on Friday. Now, it's worth noting we gapped higher at the open. We traded lower in the 10 o'clock hour. The whole rest of the day was kind of sideways. So this was not a big follow through day. Wow, a ton of new buyers are coming in. This was more of a jump higher, and then that was kind of it. This was a market treading water through much of the day here. Now, not surprisingly, because we had a couple stocks reporting earnings today, but earnings season really accelerates in the next couple days. Over the next couple days, we have some of the Magnificent Seven stocks, Netflix, Tesla, both reporting Tuesday and Wednesday. A number of other S&P names, of course, from Verizon to some airlines on Thursday. So, a bunch of other home builders and a bunch of other groups and sectors that are represented. So make sure you use our earnings calendar, by the way. Make sure you understand when companies are reporting. Use stock charts as a way of understanding the technical implications going into that earnings release, coming out of that earnings release. That's where charts can be super helpful. Look at the S&P 600 small cap ETF today, or index today, that is, up just below 1,300 at the close, and that's up almost 2%. So one of the issues that I've observed with this market recently is the dominance of mega caps, right? Sort of the large cap growth names working well, everything else working much less well. In some cases, not doing particularly well, like some of the defensive sectors like consumer staples or utilities. And we saw some of those gapping lower again today. Small caps have not particularly been a part of the success story, but you're starting to see that change a little bit. And I would say a day like today, where the small cap ETF's up almost 2%, while the S&P is up just 0.25%, that really changes the configuration that we've observed here for many moons, to be honest with you. So definitely an emerging theme to pay attention to. Do you see small caps kind of re-emerging in a position of strength? The VIX pushing back lower just slightly, though, not a big deal, but still sort of in those low teens. And I would say is one of the, I guess, release valves, one of the warning signs that I have not seen yet, that would be one of those things that would tell me that this dramatic rally that we've observed from October of last year to where we're at now in late January, impressive, 3-month move now, November, December, January, pushing higher. But the volatility has remained low. And so we've had an uptrend driven by lower volatility, or combined with lower volatility. Improvement or an increase in volatility, the VIX pushing above 14, 15, even further, and then getting up to those danger levels like 20, 25. That would be a market in panic mode. That would be, fear running rampant and investors starting to take aggressive profits. We're not seeing that yet, but keep an eye on the VIX. As always, I think looking for a spike higher in volatility is always a good warning sign to be looking for. Quickly through the other asset classes, and I want to get to more charts here. The 10-year yield moving slightly lower, just below 4.1%. The 5-year yield above 4%. Long bond yield just about 4.3%. Of course, the short end of the curve still pretty elevated. Not this week, but next week we have the first Fed meeting of 2024, sort of last week in January. No expected change in the interest rate environment from the Fed, but I would say that the Fed's Powell's press conference afterwards probably a huge focus, to be honest with you, because that is where we can start to get some ideas about the trajectory of Fed policy through the course of this year. We'll talk about, the Fed lowering rates and what they would need to see to start making those changes. And I'm sure a lot of the reporters will be asking questions, trying to tease out a timeline to some of those decisions, and be prepared for the market to move pretty quickly as we try to make sense of those things. Looking at the commodity markets, we see the DBC, the commodity ETF, up about 0.4%. Gold and silver actually down. The silver ETF, the SLV, was down about 2% today. So a big down move there. Copper price is down as well. Crude oil prices actually moved higher, but the energy sector not really enjoying any upside relative to other sectors that we could talk about. A big rotation lower continuing for cryptocurrencies. Bitcoin down almost 4%, Ethereum down 5%. It's after some choppiness over the weekend. So, just in the last 24 hours, you've seen Bitcoin on the left side of my screen going from 42,000 down to below 40,000. It's kind of right at that big round number as we're recording this show here right after the close on Monday afternoon, the 22nd. So, we've talked about how, the final announcement of Bitcoin ETFs being approved. Great, I think, for the long-term story of Bitcoin and other cryptocurrencies, not particularly great for the short-term environment. It's not surprising that you have quite a bit of drawdown in some of these areas, because arguably a big part of the rally that we saw, which was an exceptionally strong rally in the fourth quarter of last year, was driven by expectations of that approval finally happening. When it finally does happen, all the optimism has kind of already been baked into the price of those assets. And that's why I think you're seeing Bitcoin and other cryptocurrencies coming lower. I think the long-term story is still there. And if you want to know more about that, obviously go to my conversation recently with Adrian Zadunchik. He did a great job at times of laying out sort of the long-term bull case for cryptocurrencies, and particularly for Bitcoin. Looking at the sectors here very quickly, you can see industrials actually at the top of the list. It's pretty rare. I can't remember a time when recently where I've seen industrials near the top of the list. They're certainly not number one. Number two is financials. Number three is real estate. So talk about three sectors we've not normally seen at the top of the list here. Industrials are an interesting one. Trucking companies actually having a nice bounce higher today. I don't know if we'll have time to get through those, but check out like ODFL and some of those trucking names. Actually having a pretty decent go of it recently, and today bouncing higher. Financials and real estate followed very closely by technology and healthcare, sort of this cluster of four sectors up about 0.4 to 0.5%. On the downside, only 3 of the 11 S&P sectors lower. Utilities down 0.5%. So if you're looking for defensive sectors working better, indicating that investors are rotating to more defense, more risk off, you didn't get that today. Utilities actually down 0.5%. Consumer staples and consumer discretionary, honestly, all about in that same boat, down about 0.5% from Friday's close. Let's go to a daily chart of the S&P 500. You'll see the gap higher that we saw again today, and this is on the S&P index that we're looking at. I try not to pay too much close attention to gaps necessarily, particularly just day-to-day gaps on something like the S&P, because of the way that the index is calculated, the way that it is combining 500 stocks into one value. There are weird gaps that kind of happen. So if you're really trying to do a gap analysis, really thinking about a change of sentiment or a change of valuation from one day to the next, I'd encourage you to use the SPY as a better gauge of just there's a big move from one day to the next. You'll find on the chart of the S&P, there's kind of a gappy chart in general, just because of the way that the values are aggregated and posted as one particular index. But I am seeing that the index, as we mentioned in the beginning of the recap, traded higher right out of the open, but by the close, kind of right back toward the lows of the day. It's giving a bit of a shooting star candle, which would be the open and the close near the lows, a long upper shadow, limited lower shadow. Looking at the SPY, not as much of as an obvious shooting star candle. So I don't know if I'm going to I don't think that's the headline for the show today, but something to pay attention to. Certainly, just the fact that we really didn't power to the upside at all, right? It was a gap higher at the open, and then it was sort of treading water right toward the lows of the day. But the big story, I would say, at the end of last week was a push above 4,800. Friday's session, we finally closed above 4,800. Today, of course, moving a little bit higher, but I think that's the real story here. The fact that the market was range bound, about a 100-point range from mid-December to mid-January, now appears to be resolving higher. What's interesting is on the chart of the S&P, and we're going to go to some other charts here in a minute, you'll see these divergences that have popped up quite a bit. Now, the S&P is pushing higher, which is starting to make this divergence look less and less scary and more indicating a bit of a pause before the next leg higher. But some individual stocks really still in a bit of a question mark, I would say, with the price moving higher on much weaker momentum. I'll try to get to some of those if I can. Looking at the IWM, this is the Russell 2000 ETF gapping higher today as well. I'm using the IWM, as I mentioned, the ETF for this particular index. So this is a good measure of just small cap strength. We can see that the IWM broke higher and really finished in a position of strength between Christmas and New Year's. From there up until mid last week, really retracing lower. And then over the last couple sessions, Thursday, Friday in particular, and then today's session, really bouncing, didn't quite get to the 50-day moving average, but essentially a retest of the 50-day before pushing higher. Now, that's interesting because it's very different, right? Small caps have been underperforming for quite some time on a relative basis. Owning small caps instead of large caps has not been a particular winning trade for the most part. So looking to see if that reverts higher, if you have more days like today where small caps are dramatically outpacing large caps, all of a sudden this looks like a place where you could get some outperformance. One of the 3-and-3 charts that I selected really shows how large caps have dominated small caps in so many ways. If you slice the indexes in different ways, you will find similar takeaways in terms of large over small. I think that still is the theme, but I would be watching the IWM to see if and when that theme starts to change. I did want to highlight the chart of Bitcoin here just because we are trading just below 40,000. We're right around 40,000 here as we're reviewing the charts right now. This is a concerning breakdown because I would say 40,000, number one, big round number. When we broke above 40,000 in early December, that was a pretty significant, I think, vote of confidence for cryptocurrencies and for Bitcoin. From there, we settled into what I'd probably call a pennant pattern of lower highs and higher lows. You'd also call that a coil pattern, a symmetrical triangle, just a consolidation pattern. And then we resolved that pattern to the upside. Now, my upside target for that, if you take the height of the pattern, and then connect that to the breakout, it gives you an upside objective of around 49,000. If you look at the Fibonacci level, taking the all-time high down to the 2022 low, goes 61.8% of the way up. It's around 49,000. 50,000, of course, a big round number. So the fact that Bitcoin has topped out right at a confluence of those major resistance levels, not a huge surprise. Now, what's happened since then? Of course, since that moment, we've had the Bitcoin ETFs finally approved. We've seen a ton of funds flowing into those ETFs, but the price of Bitcoin is actually coming down. We've now quickly retraced from just about 48,000 to almost 38,000, right? In just a couple of weeks, we've broken down through the 50-day moving average. We're now testing that big round number of 40K. Now, I wouldn't be surprised if we bounce a bit around this level because it's an important one. The next Fibonacci level to pay attention to, 36,000. That lines up with this sort of consolidation pattern from November of last year. The 200-day moving average around 33,500. So overall, clearly a bit of a breakdown here. The momentum getting more negative. The RSI breaking below 40 is not a particularly bullish sign. That has me cause for concern a little bit. I think long term, I think this chart is still good. And I think the long-term promise of cryptocurrencies is still there, but in the short term, I think more weakness before strength. I look for a break above the 50-day to sort of reinitiate the optimism that we've seen that we observed in much of the fourth quarter of last year. Let's look at some individual names just on the move to complete our market recap, just to keep you aware of what's going on. The chart of Gilead, GILD, this is a biotech name, of course. We've talked about Gilead, and I don't remember where I've mentioned this in particular. It might have been on this show, but I have a couple of places where I tend to send content around. And one of the things that we observed with Gilead is just a break to a new swing high. We take the adjusted or the unadjusted price by taking a little underscore there. You see on a price basis, we really didn't eclipse the all-time or the long-term high from December of 2022, sort of retesting that resistance range. What's interesting though is we've gapped lower. Now this is a drug, basically bad news on a drug that a lot of optimism on that, core to Gilead's sort of game plan going forward, and all of a sudden news that it's not quite as effective as hoped. This, I would argue, is a beautiful illustration of the risks of biotech. Biotechs are a choppy, confusing, and frustrating place because a lot of, particularly small cap biotechs, to be honest, because a lot of times there's that binary outcome, right? A drug, news on a drug being approved or being denied or some issue related to it can immediately make a biotech stock spike higher or drop to zero very, very quickly. So Gilead, a promising technical structure up until today. That news hits, the stock gaps lower right down to the 200-day moving average. Sort of ended up closing right around the 200-day. So I think the question is, where do we find stability? From a technical perspective, I would keep your eye on price support around 74. That's what we bottomed out in the third and the fourth quarters of last year. So there's a pretty well-established level right around there. That's not too far. It's about 4 points below where we closed today. So there's some downside to be had before you get to that support, but that might be a good downside barrier, a nice anticipated level of support if you're looking for opportunities, if this would continue to pull back. See if it's follows through below the 200-day moving average tomorrow. That's one of the things I would look for. Consumer staples have not been a great place to be, and while Gilead I think was a surprising gap to the downside from a technical perspective, I would think what you're seeing from Archer-Daniels-Midland gapping lower by about 24% today. Bunge, BG or Bunge gapping lower about 4%, 4.25% lower today. What's interesting about these is both of these have made new swing lows recently, right? So they're gapping lower. It's not a particular great day for either of these stocks, and the sector, of course, has been on the struggle bus for quite some time. But I think what's interesting to me is those big gaps lower happen during a well-established downtrend. So I think the danger signs on some of these charts, like Bunge, and ADM and other food products names have happened way before today, right? So while the gap lower certainly can be unsettling, I think the technical signs of risk prevalent on the chart have been clear for quite some time. So good reminder that buying new lows is always a very dangerous business because price often goes down for a reason. I think those stocks are sort of showing that. To finish off the market recap, Zions Bancorp reported just after the close today. Today was up 4%. We'll see how things trade in the aftermarket and certainly tomorrow's session. But, setting up as a bit of a fat pitch chart, that's where we have a nice uptrend, a pullback to the 50-day moving average. Today was a nice sort of bounce off of the 50-day moving average. Strong earnings really could propel Zions and regional banks overall. Compelling place. A lot of these have pretty interesting setups. We'll see if earnings allows or provides some further upside catalyst there. Logitech also reporting after the close today. And when you look at the chart of Logitech, I think it's a good example of a bunch of stocks, software companies, hardware companies within technology making higher highs on weaker momentum. I think the risk to this market is that these bearish divergences take hold and that these stocks are unable to sort of make that next leg higher. Watch earnings on charts like Logitech. Watch Home Depot making higher highs on weaker momentum. That usually is a sign of internal weakness that isn't really reflected in price action, but more on weakening momentum. So watch some of those names here through the course of this week. We're going to get on to our next segment, Banking on Breadth, in a moment. Before we do so, just a quick reminder, our mailbag would always appreciate a new question. On Friday, we did an all mailbag episode. We hit on some meaty, really fun topics like, what the Fed is actually doing when it's manipulating the yield curve. What does that actually mean? Should I be using log scale or arithmetic scale charts? And a bunch of other questions. We got through about 10 of them on the episode, so I'd encourage you to go back and review those. And if there's a question that's been on your mind about technical analysis, about charting tools, about the stock charts platform, market dynamics, sentiment, psychology, whatever it is, we're here for you. The final bar at stockcharts.com is our email, and I would encourage you to contact us that way with your questions. Don't forget to follow us on the socials as well, and on our YouTube channel, of course. Just drop a comment below the video that you are watching. Let's get to our next segment, Banking on Breadth. It's been fun here recently, and as we were talking about the show in the new year, one of the things we talked about was sort of bringing back some of these segments we used to do that we got a lot of great feedback on. One of them is Banking on Breadth. If you've watched this show for any amount of time, you probably know breadth analysis is super important to me. It's a core part of my toolkit, and so a lot of the charts I'm about to show you, I have referred to randomly. But what I would tell you, and this is a note I was writing to my premium members at Market Misbehavior over the weekend, was really looking at the breadth conditions, right? What are they telling you about the conditions now? What would you need to see to tell you something is different or something is changing? I think that is a general way that you should be approaching pretty much any chart that you use, right? Think about, what is this chart telling me? How should I be positioned? And what would tell me that position is wrong? I guess are the general three questions that I would ask. So let's go quickly through some of these breadth indicators. We'll talk about what they're telling us about the current environment. We'll talk about what that means relative to the price action of the major benchmarks, and then what sort of danger signs or what sort of changes we may observe here in the coming days and weeks that could tell us that something might be a little bit different. The first I always like to start with is the breadth analysis using the cumulative advanced decline lines. And the quick version of these indicators, it's four different what I call cap tiers, four different groups of stocks. Large cap, mid cap, small cap. You can see I have the big purple labels so you know which is which. And then also the New York Stock Exchange, which is the most important one that I like to follow because it's a pretty broad universe of large cap, mid cap, small cap, all kind of in one exchange, of course. The benefit of these indicators, and most breadth indicators, by the way, is the fact that they are equal weighted. The challenge with the S&P 500 it is dominated by the biggest names. So a stock like Apple or Microsoft or Meta or Nvidia, they have huge impacts on the value of the S&P. If those stocks are doing well, the benchmarks are probably doing well, even if everything else is struggling, because those big names have such an oversized impact on the benchmarks because they're cap weighted. The bigger market cap, the bigger the weight, and the largest names have an outsized impact. These breadth indicators, and pretty much all of the breadth indicators I'm about to show you, are all equal weight, and I think that's one of the great benefits of breadth analysis. It's talking more about participation, not what the S&P or the NASDAQ is doing. We can analyze that separately. This is telling us about all those individual companies that make up those indexes. What can they tell us about the health or sickness, I guess, relatively speaking, of those individual names. So the fact that the S&P is making clear new all-time highs while the advanced decline line in the S&P is clearly not doing so is a bit of a warning sign for me. In general, when you see a strong market making new highs, when you're in a bullish market phase, you want to see breadth indicators improving over time because that tells you that more and more stocks are participating. And broader participation usually is a good sign for overall market health or market stability. When the market's moving higher on on narrow leadership, that usually has not tended to end well. Now we're coming through a period of market history where we've had a series of times where mega cap names have led and have dominated, and even other sectors have struggled quite a bit. But again, over the long term, over multiple cycles, better breadth is usually a good thing. Look at that advanced decline line in the New York Stock Exchange. Compare that to the advanced decline line on the S&P 500, and you can see why the S&P is managing to make new highs, because the things that are weakest are the smaller names, right, that are reflected in the NYSE's breadth, but really more so in the mid cap and small cap breadth. So there's large cap breadth, mid cap breadth, small cap breadth. These slopes of these three lines show you how the smaller indexes are seeing weaker participation. And that is an interesting divergence from the actual trend in the market environment. I would feel more confident about potential further upside than we've seen so far. Right? What are the chances of the S&P breaking above 5K and going even further in the first quarter? There's a very real possibility. I would argue that's probably unlikely unless these breadth indicators really improve and start making new highs as well. Right now, the S&P is making new highs. Those indicators are not. Now, we can also take that advanced decline data, of course, and massage it, use it in different ways, I guess, or have different ways of interpreting that data, of aggregating that data. The McClellan oscillator is a way of turning that daily advanced decline data and those advanced decline lines into a momentum oscillator or a momentum indicator, similar to an RSI for the broad market environment. The McClellan oscillator broke below zero the first trading day of January of this year and has remained below zero for that period. Now, when the McClellan oscillator is below zero, it tells you two things. Either we are moving down on a price basis, which is what has happened most of the time, or we're sort of in a time correction, right? Because remember, the markets can correct in one of two ways. They can correct in price, meaning we have a drawdown, or correct in time. It's more of a back-end filling, sort of choppy sideways equilibrium before the uptrend resumes. And so far, it's feeling a lot more like April, May of last year, where we actually gained a little bit of ground, but it was very little. It was more of a choppy, more of a consolidation before the rally resumed in June and July, going into the peak in early August. Maybe we're setting up with a similar type of pattern. Maybe this is a blow off top before we roll over a little bit. This is not updated for today's close just yet. But what you're looking for on this particular chart, by the way, is a break back above zero. That for me would be sort of a, big thumbs up, sort of skies clear, plenty of upside potential. I just feel skeptical about upside potential for the broader markets when the McClellan oscillator is below zero, because it tells you that a lot of stocks are actually not participating. And again, the idea of breadth is greater participation is greater benefit to the benchmarks. One place where you are seeing quite a bit of an improvement is this chart right here. This is the new 52-week highs and lows for the S&P 500 and for the New York Stock Exchange. Now, here's the S&P on the top. The second panel down is daily new highs minus new lows. And I like to do that comparison because when new highs are outpacing new lows, meaning on any given day, more stocks are making new 52-week highs than stocks are making new 52-week lows. That tells you the market is in a stronger position because you have more stocks breaking out than breaking down. And honestly, in most environments, there are companies making new 52-week highs, and there are always stocks making new 52-week lows as well. But in a bullish phase, you get a lot more new highs than new lows. So that has been the story really since mid-November of last year, coming off the October low. In the going into that October low, you had way more new lows than new highs. And you can see in these bottom two panels, lots of red, not a lot of green. That changed pretty much mid-November, where you see a lot of green and not a lot of red. And that's the environment I think we see ourselves in here. Third week going into the fourth week in January, you're actually seeing an expansion in new highs, which of all the things I'm going to show you on these charts of breadth, one of the most bullish things I could show you would be this chart showing you that there's an expansion in new highs. That's pretty bullish. Now, When stocks are in a bullish phase, they tend to be above their 50 and 200-day moving averages. The S&P itself is above an upward sloping 50-day and an upward sloping 200-day moving average. So when that starts to not happen, I start to get a little bit concerned. So about a couple weeks ago, end of last year, about 80% of the S&P were above their 200-day. Now it's down to around 72%. So about 8% of the S&P have gone below their 200-day moving average and remain below it here. And that's not an end of the world number, to be honest with you. I'd need to see this get all the way down to 50% before I would tell you this is starting to be a negative sign. At this point, the fact that we're well above 50% just tells you most stocks are still well above that long-term barometer, the 200-day moving average. So things just aren't getting that bad yet. Now, the tactical version of this, in my opinion, is the percent of stocks above their 50-day moving average. You can see this hit 90% at the end of last year. It got down to around 72%. It's bounced up to around 76%. This is a really important one to watch. If this hooks higher, I think that would give me more optimism about S&P 5K plus here in the first quarter. But my initial assessment based on this chart is it's a danger sign because it tells you that so many stocks went higher and now that's coming down, which means a lot of individual names are actually breaking below their 50-day moving average. And the lower that level gets, the more stocks are being unable to hold their 50-day moving average. Look to the left on the chart. You can see the previous times that has happened. What would be very different is if we would just rally and erase this and push to the upside. It's possible, and that's why I'll continue to observe this chart. But for now, it's certainly looking like a market that is overdue for a bit more of a pullback than we've seen so far. The last breadth indicator that I'll show you is actually two separate charts looking at the bullish percent index. First one on the S&P 500, the second one on the NASDAQ 100. And these are not updated yet for today's close or current as of Friday's close, because after the close, we go through and basically run a scan through all of these point and figure charts to update the database. So as of Friday's close, about 71% of the S&P members in a bullish point and figure profile. So a point and figure chart at any point, you can look and see what was the most recent sign. Did we have a bullish signal or a bearish signal? And those signals basically come from the rotation, right? A buy signal on the point and figure chart only happens when you have what's called a double top breakout, which means you break to a new swing high, essentially. And so the fact that 71% of the S&P members are in that configuration is bullish. So when it's above 71%, that tells you the market strength is there. When it breaks below 70%, that's where it can be a warning sign, because it can tell you that the rally phase may be ending because stocks are starting to generate sell signals, meaning they're starting to break down. Look at the end of the red shaded areas going back on this chart, and you can see why it's an important indicator I look for, because a lot of the most significant drawdowns that we've observed over the last 18 months have happened after that signal, right? After that 70% plus that then all of a sudden rotates lower. Now, we might have gotten just a bit of a whipsaw at the end of last week. You can see that I think it was Wednesday, Thursday, we went below 70%. Friday, with that strong rally on options expiration day, pushed the indicator back above 70%. So keep an eye on this. I think it's sort of at that active moment where it may be generating a signal at any point. Now, the NASDAQ 100's bullish percent index gave a big no thank you to the 70% line. It turned off of that level, never broke below 70%, and now pushing back to the upside. So the growth leadership is telling you things are still great. Keep an eye on this chart, and I think this is why these charts are so helpful. They're telling you that the conditions for now are strong, and I think when the conditions are strong, I have no problem owning things and buying things that are going up. That's the point of all this, right? That's why we're looking at charts in the first place. But I think one of the great benefits of technical analysis are patterns and signals that tell you that the trend that you've observed is now changing. It's now different, or it's now broken. Some of these sell signals that I mentioned, particularly the bullish percent index going below 70%, could be that warning sign you might want to be looking for, given this bullish environment that we're observing day to day. That's banking on breadth, hitting on some of the key breadth indicators. All those charts, by the way, are part of my Mindful Investor live chart list, which you can access from my blog on Stock Charts. Just go to articles and click on my blog called the Mindful Investor, and you can get to this list of charts along with a lot of other ones. We got to wrap the show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. I've been doing some work here in the new year as, really just a continuation of end of the year stuff. I'm looking at a lot of 2023 wrap-up type of charts, just thinking about overall trends. The fourth quarter, obviously quite strong, and so trying to make sense of how things played out. I'm doing some looks right now that we've sort of getting toward the end of the first month of the year. So that's right, 2024, almost 1/12 done. So that's I guess scary or encouraging, depending on how you want to look at it. But I was looking at just year-to-date performance. So we're starting the last trading day in December, and I'm looking at a series of growth ETFs. We're starting with the S&P 500, which is obviously not a growth ETF, but more of a core ETF as a benchmark, right? Sort of that base case. So the S&P year-to-date is now up 1.7%. Again, that's basically the first 3 weeks of the year. Large cap growth is up 3.5%. And by the way, if you want these tickers, I'll move this chart up. This is how I set this up. It's using things like IVW for growth, IWO for the Russell 2000, Russell 2K growth. So if you want to know the tickers, those are the ones to use if you put them in a chart. But getting back to what this chart is saying, basically the S&P is up 1.7%. Large cap growth is up 3.5% just in the first couple weeks or first 3 weeks of this year. Mid-cap growth has underperformed. It's only up 1%. Small cap growth for the S&P 600 is down 0.5%. The Russell 2000 growth ETF is actually down 1.7%. So there's your gap from large cap growth up 3.5% to Russell 2000 growth, sort of the smallest of the small growth, down 1.7%. So that theme of large over small that was just so dominant in 2023, I would argue for now continuing to just be reinforced here in the early days of 2024. And I don't see a sign of that necessarily changing. You are see some small cap things rallying today. As I mentioned, small caps outpace large caps, but the trend has still been large over small. It pays to go large here. Chart number 2, Logitech. I mentioned some of these companies reporting earnings here. And with a lot of these companies going into earnings season, I would encourage you to check out what we call the bearish momentum divergence. Logitech, Home Depot, more names that I could probably list out have this phenomenon. A lot of technology names, we're seeing higher highs December into January and weaker momentum. So when the price moves higher on weaker momentum, that often indicates the exhaustion point to that rally. So I think the bear case for stocks in Q1, which I still think is not off the table. What I would need to see would be companies disappointing on earnings, maybe as part of it. Some of these bearish divergences taking hold, and some of these stocks breaking down below their swing lows from earlier this month or from December. The 50-day moving average right around 90 for Logitech, only about 5% below current levels. Keep an eye on that level as well. Finally, I think on some of these leading groups like semiconductors, home builders, these are two groups that have just, making new 52-week highs here in the last week. The ITB, which is a home builder ETF, making a new 52-week high today. These are charts that are going up, and that's bullish on the surface for sure. But I think with something like the ITB, what would tell you that something's different? I have an alert on my stock charts login for this particular level right around 97. That's the gap from mid-December. We pulled back and tested that gap the first week of the year, and now we've rotated higher. So if and when we pull back, which is more of a when, at some point the price pulls back, do we hold that 97 to 98 range? That's that purple shaded area. The good news about a lot of these charts and consistent uptrends, they have very clear swing lows. And if you monitor those on a pullback, that could help you minimize losses if we start to get kind of squirrely going into the end of January and into February. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. We should be back in the studio tomorrow, but thanks for being patient with us as we do this here today. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.